the institutional world, which you've covered tremendously well with capital allocators, and the wealth worlds are kind of converging. Institutions are trying to think about how they think about private markets. The wealth channel is now starting to think about private markets. How GPs serve both is really interesting. Is the wealth channel and the insurance firm, are they the new institutional LP?
Michael, great to see you.
Ted, great to see you. Thanks for having me.
Why don't we start with your personal background and how that led up to what you're doing now with the podcast?
Yeah, so grew up outside of DC. Was a soccer player, so tried to go over to the UK to play soccer. Wasn't good enough, got injured. Ended up going to Middlebury for a year and then London School of Economics. At LSE, I ran the world's largest student conference on hedge funds and private equity. This was 2009, 2010, and 11. So it was the early days of the big alternatives managers being public, getting more into the mainstream, but still very early for the industry, obviously. Then I ended up working at Goldman Sachs. So was in London on a team that's now part of GS Growth. It was called the Principal Strategic Investments Team. So investing in capital markets infrastructure. That was pre-private markets infrastructure becoming the next market structure evolution, in my view, after equities, fixed income derivatives, but very informative in terms of how I think about the technology evolution that's happening in private markets from pre to post investment. I think it's mirroring a lot of what's happening equity, fixed income derivatives, obviously with its own bells and whistles. But that was a fascinating experience. That team was the team that invested in iCapital, more recently 73 Strings and some others. Then went to Mosaic, was the first sales hire there. It's a residential home solar loan originator, done about $14 billion in home solar loan originations, backed by Warburg Pincus. Learned a ton there. I was working with the wealth channel and then joined iCapital early on. So I was one of the early employees, pre-product, helped build the sales team with two others. And that was a fascinating experience, just seeing the wealth channel early days. It was 2014. So trying to figure out how to work with the wealth channel. Was at iCapital till the end of 2016 after BlackRock invested, and then joined Broadhaven, joined my partner at Broadhaven. He had built a financial services investment bank. It's now about 65 people, done 100 billion or so of M&A transaction volume, all financial services focused. And we started a principal investment business on top of that, first with early stage venture capital, big focus on private markets, where we have a thesis on that space. And then we'll also incubate businesses in asset management. We're currently incubating and building a GP stakes business with a former Goldman Sachs partner and BTG Pactual, focused on the lower mid-market. And then the content platform that I started, Allco's Mainstream, which kind of just started by happenstance during COVID. I wanted to connect the GP world and the LP world. And here we are talking about Allco's Mainstream.
So how did you get to the idea of the podcast?
Yeah, it's a great question. And I think it's really informed by what was happening in private markets. So I go back to iCapital, the early days of iCapital. Educating was so important. The wealth channel needed to understand private markets. The alternative asset managers wanted to understand how to work with the wealth channel. So during COVID, I was like, how do I connect the dots between the GPs, the LPs, and all the technology companies trying to work with both GPs and LPs? And it was COVID. Couldn't do anything other than meet with people virtually. I was having a lot of good conversations with GPs and LPs and the tech companies in the space, many of whom we've invested in. And I was like, why don't I just start a podcast to open source things? I started writing first, end of 2020, early 21, started really thinking about why are private markets at this point where it really feels like the adoption of investing into private markets via a technology platform was becoming more mainstream. So 2014, roll back the tape, it was hard for people to say, hey, I'm going to invest into some online platform, click a button, and invest into a private equity fund or a company. By 2020, 2021, I think people's mindset had shifted a little bit. So I just started writing, and it was everything from traditional private markets, what we see today. And that's really the big pony here is there's trillions of dollars in wealth channel capital that is looking to flow into private markets because they're underallocated. Then it was also things like more alternative assets. So things like collectibles, sports cards, crypto to some extent. That was also a driving force kind of during COVID. I think it was a ZERP environment. So there was reason to believe that was probably a little bit frivolous in many cases. But I think it was also indicative of a younger generation thinking about investing differently. And that got my mind turning. So started podcasting April of 21. with a first guest with Lawrence Calcano, CEO of iCapital, and then have since done about 145 episodes, many of the biggest GPs, many of the largest wealth platforms, really just trying to connect the dots on what's going on in private markets, and then writing weekly on different trends and themes and topics that are going on in the space, because there's just so much happening at the intersection of private markets and wealth. Also interesting that we're sitting across the table from each other too, because I think it's actually very indicative of where we are in private markets. The institutional world, which you've covered tremendously well with capital allocators, and the wealth worlds are kind of converging. Institutions are trying to think about how they think about private markets. The wealth channel is now starting to think about private markets. How GPs serve both is really interesting. Is the is the wealth channel and the insurance firm, are they the new institutional LP? So I think it's actually a really interesting time for us to both be sitting across the table from each other.
Yeah. In the couple of years you've been doing the podcast, I'd love to hear your thoughts on the evolution of both sides, of the GP side, the asset management business, and then the LP side, and particularly in wealth.
Yeah, I think there's a few really interesting and overlapping trends. So let's start with the GP world. So if we think about alternative asset managers and traditional asset managers, we'll get to that too, because that's a part of the story here as well. Alternative asset managers have evolved as businesses. Blackstone, about 40 years old, started with $300,000 of capital under management. They're now over $1 trillion of assets. About a fourth of that, 250 billion or so, comes from the wealth channel today. So it's a relatively short period of time for these firms. Blackstone's part of the S&P 500. A number of firms are public. These firms are so big, they do so many different things. They're not just private equity firms as we knew it in the 80s, 90s. They're not doing leveraged buyouts. That's one piece of what they do. But they're also doing credit. They're also doing infrastructure. They're also doing real estate, secondaries, et cetera. So these firms they've evolved from funds into firms. And by doing so, they need to think about what they are as a business, and honestly, who they want to be when they grow up, and what the industry wants to be when it grows up. So I think that then cascades to a whole set of other things. One, it's how do these firms operate as businesses? What do they do to keep their talent? And also, add new talent? Do they add new businesses, strategies? How do they work with their customers? Customers being institutional LPs who are still going to allocate to private markets, but there's obvious challenges around how much liquidity they have, how much more capital are they going to allocate to private markets given where they need to manage their own portfolio construction. And then new customers like the wealth channel. So that's creating a whole new set of products. That's creating new businesses within businesses. So I think of these wealth solutions businesses as businesses. They're startups, they're businesses. They require a lot of capital, a lot of people. You actually need to invest in it to do well and to cover the wealth channel properly. Then you need to not only cover that channel well, but that means productize for that channel. You need to create new packages that make sense. That's driving how they operate as businesses. The firms that are going public have to think about their brand differently. So there's a whole set of things that are all tied together when it comes to how these firms operate, what they want to be, and how they want to continue to evolve. That's creating a whole wave of consolidation. Dave Layton, the CEO of Partners Group, has said, I think we'll go from 11,000 plus firms or so to 100 platforms. I don't know if we'll get that level of consolidation in the space, but I think he makes a really important point, and it's a thought-provoking exercise to go through, which is if this space is going to go through consolidation, because firms need to figure out who they want to be. They either need to be really big or really niche. What happens to the middle? What happens to that $10 billion manager, $30 billion manager, $50 billion manager? Great businesses. By the way, asset management businesses, which we can get into, are fantastic businesses. They have, in many cases, if it's private equity or other strategies, 10 years of contracted revenues from enterprise customers who likely re-up. So these are, I call it, I wrote a piece about GP stakes, like it's better than SaaS. And you can make some arguments for that to be the case. So it's not like these $10 to $50 billion managers are bad businesses by any means, but they need to figure out, do they want to invest in the wealth channel? Do they want to create evergreen structures to serve the wealth channel? Because the wealth channel has a certain set of needs and requirements when it comes to liquidity, when it comes to allocating to private markets, creating a private markets investment program, all of those things. So I think the industry is at a real crossroads from a GP perspective and an asset management business evolution perspective. And then you add the wealth channel in. Wealth management itself, that business is changing. That business is consolidating too. You're starting to see a lot of consolidation happen there. So Those firms are getting bigger as well. So the large wealth management platforms are starting to look like institutional investors. As Ian mentioned, the wirehouses are putting large portions of capital into private markets. But then you have large independent wealth managers, the Creative Plannings, the Mariners, the Focus Financials, the Hightowers, the Dynasties, the Seides, the Rockefellers. All of these firms, they're growing, they're consolidating. As they grow, they need to offer private markets to their clients, oftentimes high net worth or ultra high net worth. They need to serve them well. And the way to attract and retain them is by private markets. That means they also need to mature their business. And the way they mature their business is by creating capabilities to do private markets, or in some cases, and you had another group on your podcast, Pathstone, another $100 billion firm, acquiring Allocators. And I think that's indicative of where we are in wealth management, that wealth management as both a business and the way it's investing in private markets is institutionalizing itself. Those firms are acquiring OCIOs to add capabilities that give them institutional quality diligence and processes to invest in private markets.
So let's break some of this apart. On the distribution side for asset managers, it seems like so far it's only been the largest scale players. You said you have to invest and build in this space. If you look at the different types of asset managers based on size, who's playing in the wealth space today and how do they go about it?
Yeah, it's a great question. And I think one that is on the minds of all of the firms in this space. So I think you take the top firms, the publicly traded managers, they've all made a decision that by virtue of who they are, the fact that they're in public markets, the size and scale that they're at, and what they have to do to continue to grow their business and make shareholders happy is they have to think about the wealth channel. And it makes sense. They're of a size and scale to be able to do that. I think you have to invest in the wealth channel and building out a team and process and infrastructure and product innovation and operational overhead to be able to handle working with the wealth channel. So I think you take the top firms, and I think Blue Owl had a chart recently on this, that like the top 6 firms account for the majority of market share of capital raised in private markets. On average, the top 6 firms are raising, 2024, they raised $12 billion. The top 7 through 25 firms only raised $1.7 billion. So from the wealth channel. So I think what that shows is that the biggest firms are investing large amounts of resources and capital to serve that channel. And it's critical. You have to. It requires boots on the ground. Think about just a wirehouse. There's still, I think the 80-20 rule applies. There's still, 80% of the capital's coming from 20% of the advisors. And that's even at the most sophisticated wirehouses. We're still so early. And then you talk about the independent channel. We're so early there too. I'd say roughly about on average 1 to 3% of the 145 trillion of assets that Bain talks about is actually allocated to private markets within the wealth channel. That compares roughly to a sophisticated institution, many of whom you've had on your show, 20, 30, sometimes even 40%, like CalSTR's about 40% allocated to private markets, or was a year ago or so. So when you think about the opportunity to serve the wealth channel, 1, it's huge. 2, it requires real resources. Like Blackstone has a team of hundreds of people, Blue Owl, hundreds of people, KKR, Apollo, hundreds of people to serve the wealth channel. And it's not just salespeople. You need boots on the ground and distribution, but marketing is just as important. And that's why you're seeing this dovetail with brand. So all the publicly traded firms know they need to build their brand. They need to be on social media. They need to be on LinkedIn. You've seen the running videos with John Gray. That kind of thing, I think, is actually really important. And every firm will do it in their own way because every firm has their own unique DNA of who they are and who they want to be and the culture they have. And I think that's great. They need to educate. They need to help people understand what private markets actually are.
So once you get past the 5 or 6 mega, mostly public companies, who else is getting set up to play?
I think there's firms that are maybe over 100 billion at times, firms that are 100 billion, and even like in that 50 billion plus range. Those are firms that are clearly on a growth path. There's a whole set of both scaled specialists. So I would call someone like Vista a scaled specialist. They focused on software. They're about $100 billion or so of AUM. They have products across private equity, growth, and credit. And that's a firm that specializes on one thing, software, but they're $100 billion. And that's a massive market. Those firms have built scaled firms and brands and niches and who they are and what they do, but they've done it at size. They've built a wealth team. They've hired people to do that. And I think that those are the types of firms that have the ability to get to the next stage. I think when you're kind of pushing $100+ billion, TPG went public, CVC went public, firms like that will start to think about the next phase of their business. They will start to think about, do we go public? Or do we become part of a larger platform? Because at some point, like, you need to be a very large scale platform and serve investors across the different strategies. With this next wave of managers, you'll also see more willingness in certain cases to partner, where maybe a firm that's great at private equity or software investing might say, hey, I'll partner up with someone who's great at infrastructure. We're never going to get into the same category ourselves because that might be a little bit too hard. But let's partner and let's do a model portfolio and let's do across the different strategies. Because the reality is, the question for the wealth channel is, what is the right product at the right time and how do you package it up in the right way?
So if you're not 50 billion or north, what do you do if you see this as an opportunity, but you're never going to have the resources to go deploy a huge sales force and reach the distribution in that way?
The firms really have to ask themselves, who do they actually want to be? What investment culture they want to have? I think to some extent it can also get into the firm dynamics. So how old are the managing partners? And how young are the next wave of managing partners who might run the firm over time? How does the next generation stay and continue to operate in a time when I think fundraising is going to get harder? I do think we're in a world where the largest firms will be able to raise capital, particularly from the wealth channel, because of sheer size and scale. So the smaller firms, I think, really have to ask themselves the question, do they want to be in this business? Because I think it requires, if you want to truly go big and compete with the largest firms, you have to have tens, if not hundreds of people focused on the wealth channel. You have to productize for the wealth channel. That probably means creating some form of an evergreen product structure. So tender offer funds, interval funds, things of that nature. And that doesn't just require resources on the distribution side. It requires resources on the operational side. And it also requires having enough deal flow. The reality is a lot of those firms are probably going to say no, and that's fine. It doesn't mean A, they don't have a great business, because they do. And B, it doesn't mean that they can't focus on what they're really good at and say, I am the best at this strategy or this space, and this is my differentiation. And then the third piece of it is, I think we're probably going to see more and more consolidation. So some of these firms might end up becoming part of larger platforms. So there's the big alternatives platforms who might need to add one or two capabilities. They have most of them, might need to add one more. Hard to build sometimes, not easy to integrate either. And then I think we'd be remiss if we didn't talk about the traditional asset managers. So BlackRock acquired GIP and HPS. Now, those are blue chip firms, 100+ billion of AUM. They acquired them for over $12 billion in each case. So there are firms that will get acquired.
What is the ecosystem like for just the distribution side? So someone wanted to say, okay, I'm not going to build this myself, but I'd love to partner up. And the platforms, or there are other, like the equivalent of the third-party placement agent in the institutional world. So placement agents call on RIAs, and they call on the sophisticated wealth managers and family offices for sure. There are platforms like you mentioned. So iCapital, Case, they have marketplaces. They enable the smaller firms. And there are smaller firms on these marketplaces that can raise capital from the wealth channel. So any wealth manager or wirehouse advisor, RIA, can go on to iCapital and find funds to invest in. They can invest in Blackstone, they can invest in Apollo, Blue Owl, KKR, et cetera. But we're at this point of crossroads where firms, I think, particularly the larger wealth platforms, so think the Seides, the Rockefellers, the Focus Financial, the Hightowers, et cetera, are thinking about how do we create customization for our clients and differentiation? Because any advisor can now get access. Are they? No. But could they? Yes. How do we create customization and differentiation, but also do that at scale? So I think that actually gives smaller managers hope, because I think there's a world where some of the larger, sophisticated wealth platforms will want to do things that are more differentiated. In certain cases, that will mean
working with the largest firms. And I think there's a prevailing view out there that people are doing more with less. That has happened on the institutional side for a number of years, dating back to the 2010s on to today. And I think that's starting to happen with the wealth channel. So large wealth platforms are thinking about doing more with less, because if you're a $100 billion firm like a Seides, you can't spend time on a $10 million allocation. You have to think more like an institutional investor. So that does mean that they'll consolidate their relationships, but they also have to think about differentiation. So I think there's room for really high quality, smaller, more niche managers. If they're really good at something, I think they will be able to raise capital from the wealth channel. The question though becomes, can they properly find and service the wealth channel? I think that's really one of the next phases of this space, particularly in the wealth channel, is figuring out, and this is a bigger topic and question, and I think there's yet to be determined what the answer is.
I'm going to turn over to, let's call it the LP side. There are these different channels. You talk about wirehouses or a private bank, an RIA. I'd love you to walk through the different types of players on the LP side and the wealth channel.
Yeah, I think the wealth channel is not just one thing. I think that's also what's been so challenging about working with the wealth channel relative to the institutional channel. The institutional channel is relatively similar cadence in terms of how a GP would sell. They know when their investment committee meetings are. They know the cadence for how they buy. They often are able to know the cadence for how they re-up, when they re-up, and what that whole process is. And by the way, the institutions also have very sophisticated cash flow models and return hurdles where they understand this is how much we need to allocate. This is what we need to generate on an annualized basis for our constituents, whether it's a pension or a sovereign or an insurance company. And they have all of those pieces in place. So it makes fundraising, well, never easy, harder in today's environment, and very long sales processes, I think much easier than the wealth channel, because we get to the wealth channel and a wirehouse is very different from a family office, from an independent wealth advisor, from a wealth platform. So if we think about it, let's start with the wires. The wires, I still think, will be the largest source of flows to the wealth channel, from the wealth channel into private markets. And I think there's a simple reason why. I call it the wires are plugged in. So I mean that figuratively. I also mean that to some extent literally. So wirehouses, who are they? They're the big private bank complexes. So it's the Merrills, the Morgan Stanleys, the UBSs. They have tons of resources. They have CIOs, and they have diligence teams focused on finding, sourcing, and vetting, and putting private markets managers on their platforms. That's for advisors to then pick from. It's a menu. Now, they have a different compensation model than the independent channel. So there's always questions as to why are those managers being put on the platform? There's placement fees involved at times. Not always, but at times. And that does drive why an advisor may pick a certain manager versus another. But having said that, they are very institutional in quality and in process. So the CIO will decide we need this type of asset allocation. The alts team, diligence team, will figure out which managers they want to put on the platform. They'll have some larger managers. They'll have some smaller managers. But there's so much fund. There's so many funds that are on the menu. I think one of the large wirehouses has like 60 different evergreen fund options. So there's a lot of choice. Now advisors have to pick and choose. What it means is the biggest GPs are probably best placed to cover the wires because they have the resources to actually cover all the different advisors, serve them, whether it's doing large events with them, whether it's going and meeting that advisor in the office in Dallas or the Midwest or California or New York. So you need the resources and coverage model to be able to do that. So I think the biggest firms will probably benefit most from working with the wires, and it's the most institutional in process and nature.
How does the decision-making work for when an allocation goes to a manager at a wire?
So there's a few different elements to it. So CIO is often responsible for picking and setting, like, here's an asset allocation framework, and here's the types of strategies we want. The alts team and diligence team will do the work to figure out which managers are the right fit for that. The advisors then have a menu to choose from. So ultimately, it's the advisors making the decision. And that's where I think this actually is a is not a simple sale because different advisors are in different places on their educational journey in private markets. Different advisors have different client types. So you could be at Merrill Lynch and you might be an advisor team that has ultra high net worth, $50 million, $100 million plus clients, billionaire clients. But you could also be another Merrill Lynch advisor and have mass affluent clients. So I think that actually makes the job, one, really hard for the CIO and the alts team figuring out what products are the right products to have on the platform to serve the various spectrum of advisors that we need to serve. We're starting to see the independent channel, which is the fastest growing part of the wealth management space. So it's growing faster in terms of assets than the wirehouses. So that's things, and by the way, there's different models in the independent channel too. There's platforms like Hightower, Focus, Dynasty that are basically they provide the platform and services, including the alts capabilities and investment services in addition to technology stack, to true independent platforms, which are just totally independent, have their own business, maybe they're private equity backed. But all of those firms then have different ways of deciding to source and implement private market strategies. Now, I do think that the big platforms have a head of alts, they have a CIO, and now they're starting to do things top down. So they're creating menus, they're creating diligence processes, and then they're helping their advisors saying, here's a set of products that we've done diligence on, we've vetted, we've sourced. This is a menu for you to work with. And by the way, there is value in that because those firms are now getting so big, you can start to drive some terms. The other parts of the wealth channel, family offices, when you know one family office, you know one family office. That could mean it's very institutional in nature. That could mean it's a principal making decisions, and that's the way that they run their process. They could be larger, they could be smaller. That's also a hard market to cover because every family office is different, but they don't necessarily have the same decision-making cadence as a large institutional LP. Then you have the whole independent channel and broker-dealers. You have like the Osaics of the world, the LPLs. They're just starting to get into private markets. In many cases, not always, but they tend to have more of the mass affluent client types. Those firms are in part serving that cohort of investors. So you need to create new products to meet the needs of those clients. And then I think you're going to have the self-directed individual investors. So recently Schwab launched an alts platform. So for their brokerage clients, so individual high net worth investors, 5 million net worth and above, Schwab has a few $1 trillion custodied and of assets held at Schwab in brokerage accounts from individual investors. And if a portion of that, I think they said they'd like to get 5% of those client assets allocated into private markets, you're talking about hundreds of billions of dollars. And that's going to be more self-directed in nature. And even I think we'll get to the Robinhoods, the Revoluts, the SoFis, which has embedded some private markets products to the wealth channel within their complex as well. Like that's going to be really interesting to see how that works. And that's where I think education and brand matter even more.
How does the way the wirehouse investment decisions get made compared to a private bank platform?
All the private banks know they need to serve their ultra high net worth clients in a very unique and different way. So why did Goldman Sachs, as an example, launch Apex, which is a family office platform for their ultra high net worth clients? They're doing things like more direct deals. And I think we're at a really interesting place for the private banks in terms of how they're thinking about servicing the wealth channel, that they know they need to differentiate. How do we offer things like late stage private companies that are really interesting and compelling that only we have access to because we have a broader platform? How do we get access to sports teams investing in sports alongside some of the funds or maybe into the funds in a unique way? Those types of things, I think, are what private banks are trying to do to differentiate themselves, because now the wealth management space is getting increasingly competitive and crowded when it comes to accessing private markets.
If you look at the range of different alternative investment strategies, where today is that capital that's coming from the wealth going?
If you think about the different strategies within private markets, we'll hit on the major strategies. So private equity, which has the largest pool of capital within the $15 trillion or so of private markets assets. So it's about $5 or $6 trillion of assets. Private credit is growing. It's grown from a few hundred billion to over 1.7 trillion over the last few years. And if you take what everyone from Blackstone, which has said $20 trillion market, to Ares, $30 trillion market, to Apollo, $40 trillion market. So anything on a bank balance sheet, there's a lot of room to run in private credit. And that's a growing ecosystem. You have real estate, which is a large market. You have secondaries, first private equity secondaries. And there's a lot of structural reasons why that might make sense because people need liquidity. You have private credit secondaries, which has grown, I think, 17 times. Still a small market. It's like 30 billion or so of assets, but growing because private credit is now growing. So that's another really interesting category. And then infrastructure, also another growing category, where there's trillions of dollars required to finance massive mega trends, rise of AI. So investing in data centers, decarbonization, those are multi-trillion-dollar trends, tens of trillions of dollars where capital is going to need to go. And the private sector is probably going to fill some of that gap. So big infrastructure funds. And then GP stakes, which is a small but growing market and ecosystem where I think if you believe in private markets growing, betting on the growth of asset managers and their AUM, there's reason to believe why people may look at that and say this is a derivative of this whole space growing.
What is the value proposition that the ultimate buyer in private wealth is looking for?
So I think first and foremost, it has to be excess return. It has to be about generating alpha. Now, there's a nuance to that, which is in private markets, I think there will be firms that truly generate alpha, and there will be firms that have private markets beta or private equity beta. Now, then the question becomes, is the private markets exposure on a risk-adjusted basis, factoring in most likely illiquidity, if the returns are still greater than what you can get in public markets, then I think there's a reason to do private markets. That still gets to things like manager selection really matters. Second thing, I think they're going to think about what managers can we work with and work with over a long period of time. I do think that tends to favor the brands. So I think it's going to be easier for managers who have big brands and large multi-strat platforms to be able to win dollars from the wealth channel because they're a brand that people know. And I think it's no different than on the public side or in the institutional side where people will be able to sleep at night if they work with the top brands. But at the end of the day, though, I really think this has to come down to investors have to be able to generate better returns than they could by investing just in the alternative.
I'm curious your thoughts on how hedge funds may or may not fit into the picture.
So you are much more of an expert on hedge funds than I am. I think hedge funds are in an interesting spot. They're by no means a small part of the universe. I think the large multi-strat funds have done a great job of building their businesses too, right? The big pod shops, 60 plus, 70 plus $billion. And those have become the ways to allocate to the hedge fund space. What has been interesting from my perspective as somebody who's focused more on the other parts of private markets is that you are starting to see some hedge funds think about private credit. And you are starting to see some hedge funds think about longer lock vehicles. So they're kind of getting into certain aspects of private markets that a larger multi-strategy alternative asset manager would play in, which is interesting. And I think they are not ignoring the wealth channel either. There are plenty of larger hedge funds that are on some of the big capital raising platforms. Certainly, they've worked with private banks for years. That's where a large portion of the wealth capital has come from. So I think that hedge funds will certainly play a role in all this.
How does the private wealth LP think about hedge funds today?
There are certain firms that have done hedge funds for a long time, and I think that will continue to persist. I think that there's a set of newer LPs that I imagine they will probably think about hedge funds. The challenge is you almost have to do a two-layer sale. It's marketing and educating the advisor, and it's marketing and educating the end client. The firms that people know about are probably going to be the ones that more likely get allocations and people are more comfortable with. I'll call out a Bain survey from 2022. Bain & Company asked 418 ultra high net worth individuals. Name 3 firms that come to mind when you think of alternative assets. And who are the providers? First answer, the biggest answer in the bubble chart was, I don't know. The next three, Schwab, Fidelity, and BlackRock, which in 2022, Schwab and Fidelity were not doing private markets then. So I think that shows how important brand is. And it also shows how important being public is.
When private wealth has invested in the alts, there's this set of different vehicles that create more liquidity than historically you saw, say, in private equity drawdown fund. I'd love to walk through these different names you hear, right? Evergreen structures, interval funds, tender offers, just what they are and how they get rolled out.
Yep. So, and I'll be talking more about private equity and other alternative asset classes as opposed to something like hedge funds in this context. But historically, the way that people invested is they're closed-end vehicles. So closed-end vehicles or drawdown structures. It puts the onus on the LP in terms of how they manage the rest of their cash flows. The wealth channel, historically and generally speaking, has not liked the fact that there's really no liquidity for 10 years, which if you're an individual investor who's a taxable investor, you're in your 40s, maybe you want to buy a house. So that can be a challenge just mechanically in terms of private markets being the right type of investment for people. So evergreen structures create some sort of mechanisms that enable things like liquidity. So let's break down evergreen structures. There's tender offer funds and there's interval funds. Those are slightly different structures. So with tender offer funds, there are periods of time where at times that a GP says we want to buy back part of someone's investment at NAV, at net asset value, we can do that. That's generally at the discretion of the GP. So yes, there is some liquidity, but not always. Interval funds are periodic times where at certain intervals, other people, other firms can buy existing LPs holdings at net asset value again. Evergreen structures are generally lower fee, 125, 150, maybe 175 in certain cases, lower carry, so generally not 2%, but the management fee and carry is charged on net asset value. So as businesses compound and net asset value grows over time, in theory, you can start to generate real fee streams on that 125. So if you do the math, would you rather have, 10 or $15 billion at 125 or a $2 or $3 billion fund that you have to raise or $5 billion fund that you have to raise every 3 to 5 years at 2%? So I think it's creating some really interesting business dynamics and questions. Now, again, Goldman had a report on evergreens in 2024, the fall of 2024, and there's really only, in the US at the time, there's like 200 evergreen funds. So there's not a lot of choices relative to the thousands of closed-end funds that people can invest in. Evergreens just make it easier. It's like easier to invest. You don't have to worry about it. The capital compounds in theory. And then you get a 1099, you don't get a K1. So it's just easier from an operational perspective.
So for an investor in an evergreen fund, if the manager needs to be able to provide some liquidity, whether it's an interval fund or a tender offer, what dilution would you expect? And if you're thinking about expected returns compared to a drawdown structure?
So some firms have put out white papers that are based on data and backtesting. And I think they've put out some really good charts because I think it puts it in context of, like, if you're in a drawdown fund, you have to generate high teens returns to get the same multiple on invested capital outcome over a 10-year period as you would if you're getting low teens IRRs in an evergreen structure. This gets to a really important point when it comes to thinking about evergreen structures, both if you're an LP and if you're a GP thinking about creating an evergreen structure. The question that people need to ask is, what is, one, the deal flow? Does this firm have the capacity and ability to source enough deals, either from their own platform? The other aspect of it is investor management. So it's great to be able to raise a lot of capital, but to your point, if you raise too much capital and then don't have the deals to deploy that into, then what that's doing is that's just dragging down IRR for for the investors, then it requires a different skill set in terms of managing the investments, because you have to know A, what to source and when and how, but then B, actually how to manage that asset properly and when to get out. Because you need to be able to create the ability to distribute capital back to investors. You need to have a team across the investment team, the IR team, and the operations team that's all working in unison to be able to make sure that things are done properly, from sourcing deals all the way through to capital raising.
I'd love to ask you about the implications of all of this fund flows to come and the structures on really the existing institutional community. And start with, what do you think happens to asset prices in the private markets as this money seems to coming in with demand that no one's really talking about at what price?
I've thought about this in the context of like, is this alpha in search of beta? But again, I think I say that a little bit tongue in cheek, but I think what this does go back to is, for the risk people are taking, illiquidity risk, being in private markets, are people still generating returns that are in excess of what they're getting if they're only in public markets? Now, it's a really fair question. As more capital comes into the space, do returns go down? I think it would be hard to say, without knowing and having a crystal ball, I think it'd be hard to say that the answer is no. I think in certain sectors and categories, multiples have gotten higher, and I think that's very much the case. If you look at the difference between lower middle market and the upper end of the market, multiples are generally lower in the lower middle market. So I think there's still pockets of private markets where you can generate returns. There's also areas of private markets where scale really does matter. Like, again, we talked about private credit or infrastructure. Like, how many people can do a $20 billion deal in infrastructure that like BlackRock recently did, or GIP did, the Panama Canal? Like, there are very few firms that can do that. And I think, and in the rarefied air, there are sometimes cases where being really big can help, and you're not competing with a ton of other people. So you actually may be able to get good deals or get good assets at fair prices. But I do think there's that's a question that private markets is going to have to answer, because investors are coming into this, and they're coming in at a time when more capital is flowing into the space. So I think it's a very fair question. I think that also brings us to the institutional side of things, which is institutions are not going to become insignificant allocators to private markets. Insurance companies are going to be much bigger allocators. Lincoln recently partnered with Bain and Partners Group, these really strategic partnerships. They have hundreds of billions of dollars from the general account to invest into private markets. So the institutional channel is not going away. I want to be very clear on that. I do think the creation of evergreen funds brings up a really interesting question, though, which is, you've seen over the past 15 years in private equity in particular, and private markets in general, that the largest GPs have found ways to strategically partner with the largest LPs. So think like large sovereign wealths, or the Maple 8, the Canadian pensions, CalSTRS, CalPERS, et cetera, where those firms were able to drive down fees by doing fee-free co-invests. And that was in part to help these managers do bigger and bigger deals. The question becomes, with evergreen structures, if a GP can generate fees on the evergreen structure, why would they give that away fee-free to co-invest? So I think that actually brings up some really interesting questions. And I think what that means, and firms I think are certainly acutely aware of this because they know how important the institutional customer is to them, that there needs to be harmonization between the institutional investor relations team and the wealth solutions business. All of this is thinking through, how do these customers work with your business, and how do you integrate them both into what you do?
As you look out over the next few years, this is kind of a dovetail question between your podcast and your investment interests. What excites you about both what you're trying to cover and then how you're trying to capture, say, economics from the opportunity set?
A few things. I think all of these things cannot be made sense of in isolation. What do I mean by that? I think the different activities that I'm doing give me a very interesting perspective, and they're all related. So the investing side at Broadhaven Ventures. We've invested in 20 companies from pre to post trade in private markets. I think the technology revolution in private markets market structure from pre to post investment. How do you find investments? How do you execute investments? Post trade, how do you manage, track, value, all the data, et cetera? That can't be decoupled from the evolution of asset management as a business and the distribution evolution that's happening on the private markets manager side. So I think both of those things are happening. Then there's a whole set of things that come from that are related. So one is, I think we're seeing an evolution in asset management where there's consolidation and there's this barbelling of like, you either need to be really big or really unique. We've also thought about this from the lower middle market, where if there's consolidation, finding top niche managers, like that's why we own a portion of Cantilever Group, the GP stakes business in the lower middle market, because we see that as technology improves to be able to serve the wealth channel better, so things like iCapital, which I was involved with and was an investor in as well, all the way through to evolution of asset managers as a business and trying to work with the wealth channel, the lower middle market is actually pretty interesting because there's going to be really niche managers that are going to grow their business in a core area and strategy that they're very good at, very focused on. Maybe they get consolidated or they get sold to another larger stakes business or that position gets sold to a larger stakes business. So I think like that's why we've made a bet on the lower middle market of alternative asset management, because I think even if the lion's share of capital goes into the largest firms, there's also going to be more capital going into the smaller firms than there was in the past. And going from 1 to 5 billion or 5 to 10 billion, that's probably more doable than going from 50 to 100 billion. And then the other piece of it is the content side of things. I think for this space to continue to mature and grow, content is going to be critical, and content's going to be at the core of how firms think about capital raising. So you're seeing it with the largest firms. You can't think about this space without seeing what the largest firms are doing in terms of the fact that they are using things like LinkedIn as a way to communicate with investors. They're putting out tons of research and white papers. They're building out content teams. Yeah, I think that's emblematic of where this is all going. So I think content's critical. And that's honestly, I started this because I really just wanted to help connect the dots in this space. It's become a business across content, community, and capital. I think all of those three pillars of AGM, content, community, capital, all go hand in hand because you need all three in today's world. On that point too, I think marketing is as important as distribution and sales. You need the aerial support from marketing and the constant barrage of information and communication with investors. And that can enable smaller firms to punch above their weight. If they do a great job of marketing content, you got to invest in marketing too.
Michael, I want to make sure I get a chance to ask a couple of closing questions. What's your favorite hobby or activity outside of work and family?
So two things. I love being outside in nature and hiking. The other thing that I love doing is I actually collected sports cards for a long time. That's a really interesting category. I think we have a company that we've invested in that space that's built an exchange for sports cards called Alt. And I think that's, while smaller than the other alternative asset categories we talked about, it's a really interesting category where I think that's where culture intersects with investing. So I love collecting sports cards. I love supporting sports teams.
What's your first paid job and what'd you learn from it?
My grandfather employed me at his antique show every year. I'd also work in his store at times. He was an antique dealer in his second career. And we'd every summer on Long Island go to the antique shows and we would sell for him. We were kids. My cousin and I we were 10, 11, 12. And we would be selling antiques. We'd have to price everything. We'd have to run around the antique show and try to find things to buy and see how much something was, negotiate, and then bring it back and then try to sell it, in addition to selling all the stuff that he had. So it was just a ton of fun. I learned all about how to value things, also how to sell, and how to really understand people and understand what they were interested in, and also talk to them. I mean, my grandfather was so good at this. He would build a relationship with them and he would talk to them about what they were interested in. Sometimes they didn't buy anything, and that was fine. Maybe the next year they came back and they did. And I think that's so instructive on what really business is about, right? It's about building relationships. Sales come at the right time when they come, but people have to be A, interested in buying something, and B, they have to trust the person that they're working with.
How's your life turned out differently from how you expected it to?
I certainly didn't expect to be in finance. I studied international relations and social policy. I worked for Room to Read as well. So in the year I was trying to play soccer again after being injured, I worked for John Wood and Room to Read, an international literacy organization. And I thought I was going to do something that was related to the international relations world. I ended up falling into finance. But I think one comment on that is I think that finance is so critical to what makes the world move. And this is really honestly about what private markets is. How do you unlock access for more people to investing, particularly in emerging markets? How do you give people access to things in financial services? Because it's so critical to what they do in their day-to-day life, how they buy a house, go to school, how they save for retirement. All of those things are related to finance. So even though I didn't study finance, I'm glad I ended up in it because it's so central to what everybody does every day.
What's a mystery you wonder about?
That's an interesting one. I think it's with everything that's happening in AI, how will people learn going forward and what will be valued? So as a world becomes, particularly on the content side, more commoditized, if you think about it, AI might start to write and be smarter than people in many ways. How will original content actually matter? I wonder what will happen as content and things become more commoditized from AI. How will people, not just through writing or content creation, but how will people build and maintain genuine connections?
Michael, last one. If the next 5 years are a chapter in your life, what's that chapter about?
My focus is on the private markets world. I think it's such an interesting time in this space where we're only in the early days of more people having access to private markets. I want to help be part of that by helping to educate the community, both the GPs, the LPs, everybody else involved in private markets. There's really big questions that society is facing. And I hope private markets can play a role in that. I think a lot of it's going to happen in the next 5 years. I think that feels like the window.
Michael, thanks so much for sharing all your wisdom about what's happening in the wealth space.
Thanks for having me, Ted. Really appreciate it. Yeah.